All righty. Welcome everyone to today's Sunday macro wrap up for Sunday, April 13th. Man, what a crazy week in the markets. Just when you thought it couldn't get crazier, we have a market like last week. And just like the title of this video says, something definitely broke. All right, 1 second.
I hear you just fine. I think you're good now.
Can you hear me?
I hear you just fine.
Perfect. Yeah, so last week, very interesting week. It was quite rare, actually, which we'll get into in a second. And I kind of alluded to it in the most recent video that I put out on Friday. But we're going to be getting into that, the market, some of the macro data that we've been looking at and getting, all of which is very important right now. Man, macro is just, this is a very interesting time in financial market history. Lots of firsts, as well as, this is just very uncommon. And so I'm just really excited to get into what we're about to get into here. So if you have any questions, just leave those in the comments. For those of you that are joining on live stream on YouTube, TikTok, as well as Instagram, the way that these Sunday macro wrap-ups work is that the first hour or the first 30 minutes of the hour is streamed just to go over some of the things that I'm looking at. And then the second half hour to 45 minutes, that's actually closed off from the public and only for our Macro Optics members, where we're going to be going over more so the actual ideas based off of the data that we're about to go over, as well as I'm going to be answering only the questions from the people in our membership group. And so, yeah, I mean, we're going to be going over a lot of this data. But, there's a lot of actual ideas to still take place. There's a lot of ways to actually make money in these markets. Just because volatility is high doesn't mean that you're just out on the sidelines, not participating. So without further ado, let's just go ahead and get right into it here with this chart that I have shown, which is the dollar index. And so the dollar index right now, the DXY, the reason why we always start with the dollar is because, the old saying goes is that, if you get what the dollar is doing, you'll be able to get what a lot of the other things are doing, right? And so with the dollar bearish right here, this has reached levels that we haven't seen since July of 2023. If you look closely, it wicked down to levels, that we really haven't seen since the bear market of 2022. And so typically when the dollar is bearish like this is showing that the Fed could be cutting rates soon, and that there is just an all-out effort for dollar to basically, a bearish dollar is not great for not only the United States but for the world economy as well. You have to remember that not only is there a dollar-based financial system in the United States, but there's also a foreign-based dollar market called the euro dollar market, where that's all of the dollar-based debt that a lot of foreign currencies also have. Right. So I know that the past couple of years, there's been a narrative out there that, the dollar is going to be dumped, the BRICS nations, all those other things. But the fact of the reality is that over 60% of all global transactions still happen in dollars. Oil transactions are still denominated in dollars. And really, a lot of the global based debt is in dollars. And so you can say all you want about the dollar and how trash it is as a fiat currency, the reality is that it's still the most used one out there. And there's really no alternatives that are being considered currently in order to replace this. That could change in the future. Obviously, there's everything surrounding Bitcoin, and maybe if we ever go back to a gold-backed currency, but that's not the point. The point is that when you see the dollar do this, the next question is, okay, what is the dollar? What are other things doing in response to this? And so that's why we look at the bond market next. And so the largest bond market that we look at is the 10-year US government bond yield. And this move in bond yields, this is let me see. This was a 60 basis point move in 5 days. That is absolutely insane. Something like this, a lot of people have been speculating that China is dumping bonds, US bonds. It could be, but really, this is just a signal of just a mass panic to, cover a lot of dollar-based debt, right? You're seeing markets like in Japan. You see the Japanese yen continue to rise, other currencies continue to rise. There's actually tightening going on globally right now. And so when there's tightening going on globally, a lot of people will say, okay, if there's tightening going on, I need to start covering the dollar-based debt that I have. And so what do you get rid of? You get rid of things that you can convert into dollars. And the easiest one, other than gold, is US treasuries. And so it's interesting to see this rally here as dollar is falling. And an interesting just historical context is that the last time that this happened was in the early 1980s. Right? So there was a similar pattern that happened in 1982 amid high inflation, aggressive Fed rate hikes. Now, the Fed obviously isn't raising rates right now, but the Fed is absolutely scared out of its wits that inflation is going to reaccelerate because of the Trump tariffs that are going on, right? Which we'll see what the exact effects of those are. We're not going to know that for several months from now. But a lot of the times, if something isn't as bad as what people expect, it's the expectations of how bad it is what causes a chain reaction so that a recession does in fact happen. It's kind of just like a self-fulfilling prophecy. It's just like, if you have an attitude throughout the day, you're probably going to have a bad day. Even if you get a hole in your tire or whatever, it's all about the reaction. The reaction becomes the reality. And so that's why when we're looking at market reactions versus what the actual data is doing, yes, they're two different things, but they're also related. And so seeing the dollar crash the way that it's doing right now and seeing bond yields skyrocket, meaning that bond prices are also going down, that's a very rare scenario. Another time this happened was in 1971 during the Nixon shock. This is when President Nixon took us off the gold standard, right, causing a huge dollar devaluation and gold prices to surge. I'm not saying that that's happening right now because we're already devalued from gold, but they're also talking about revaluing the gold right now. And there's talks about trying to figure out how much gold is actually in Fort Knox, and you're seeing gold be the best bull market in 2025 so far, which my team and I have been long since it went bullish in our model all the way back in January 10th here. So this has been something that has been our top allocation, and it continues to be. And it's up nearly 20% since our model went bullish on it. And so when you're seeing gold do this, the dollar do that, and bond yields do that, so bullish gold, bearish bonds, bearish dollar, that is not only a flight to safety, but a flight to generational safety. It's looking past the United States as a safe haven, which is a pretty crazy environment. Bond volatility has been rallying. That's not necessarily, this is a sign of tightening typically. Obviously, looking at US equities, we have the volatility index of the S&P still above 30, even though it has come down, right? We're having a little bit of a bounce here in the S&P 500. Futures just opened up a little bit ago, and it's slightly down for futures. We'll see what happens. I would not be surprised if this bounce in the S&P 500 continues up this week. We shall see if less bad news continues to happen. Not to say that we're going to be, not to call a bottom and have and declare that we're just going up from here. I fully expect that I fully expect that there's a higher probability of further downside from here in the U.S. markets. Right, the bookshelf is still red. Bearish S&P 500, as well as NASDAQ, as well as Russell 2000, as well as mega caps. It's not changing just because they're having a bounce. But also as well, what's interesting is what hasn't been working alongside U.S. equities, which is emerging markets. So the euro, this is the Euro Stocks 50 index. This is essentially the Eurozone market that has been in a bullish trend, but as of recently just completely flopped back to bearish. And so this is again thinking that foreign markets, foreign countries are now ditching equities and going to safety, trying to cover their dollar-based debt. And yeah, you really don't see this. I think the last time you saw this happen was like 2020 during the COVID panic, as well as in 2008. Because you have to remember, like during 2008, during these crazy events, there's always a catalyst, right? The spark that gets this going, that gets the panic going. In 2008, it was the U.S. Housing bubble, but that's what caused the spark, the initial fire, but that's not what perpetuated the fire throughout, right? The actual 100-mile-an-hour winds that caused that spark to turn into a crazy wildfire was the foreign dollar-based debt that was just incredibly leveraged, and that's what was the 100-mile-an-hour winds that caused it to be much worse than it is, and we're even at higher levels now. So who knows what that spark will be? I mean, we're getting early signs that could be happening again. We'll see if it's contained. Obviously, there's only one tool that the Fed can do, and that's print money. So we know it's coming. There's no doubt about that. But to try and time the bottom right here, I think would be a little bit premature. Darius Dale over at 42 Macro. I'm sure you guys have heard about him before. Pretty insightful. He has a lot of great charts. Something that he says is that, and this is credited to him, is that you don't buy when there's blood in the streets. You buy when there's a catalyst that happens to start cleaning the blood up in the streets. Meaning, you don't buy when things are just crashing. You buy when there's something that comes in that tries to save it, such as stimulus or whatever. Really, that's the only thing, right? Government spending. And so yeah, I think it would be premature to just try and call a bottom right here. We still have a lot of things coming down the pike, such as not only with these tariffs, but the bigger problem, which is the global debt refinancing that's happening this year, right? Over I think it's $9.4 trillion between corporate as well as U.S. Treasury debt. Majority of that is U.S. Treasury debt, has to be refinanced this year, and rates are still incredibly high. That has to happen. And the majority, I think it's like 70% of all that has to be done by the end of June. So, it's already in the middle of April. That's a very short amount of time. And I'm not hearing any headlines about that just yet. Everyone's still just focused on tariffs. But there's still a lot of other dangers that are out there on this trail that we're going through. And so obviously the pattern right now is growth is still slowing. When you look at the price of oil, the price of oil has completely collapsed recently to levels that we haven't seen since 2021. But that was when it was on its rise. So the last time that you saw prices come down this much from a drop really was back in 2018. As well as you can say during the pandemic, but really from upper levels down to here was back in 2018. And this is just a sign of global demand slowing, as well as, oil, even though it's not gasoline, it's still a large component of U.S. Inflation. And so that's amid easier comparisons or comps heading into later in the year, our team, even though there's a lot of narrative out there that these tariffs are going to cause inflation, it could definitely cause inflation and prices to rise in certain sectors. But to see aggregate inflation CPI rise just from tariffs, we're not seeing that in the data that we're looking at. We're seeing that inflation is going to continue to come down. Now, if inflation does start to slow, we could get, if growth starts to actually come back, then you could see a more sustained and healthier rebound rally in the S&P 500 stocks as well as crypto. But that's not what's looking like from here. So we have inflation continuing to come down. The currency market is pretty interesting right now. So obviously, when you look at the DXY, the dollar index, this is only comparing the dollar to a basket of about 6 other foreign currencies, and it's heavily weighted on the euro. And so when you take a look at the euro FXE, this remains in a bullish trend. Same thing with the Japanese yen. Here's some other bull markets. The biggest one being the Swiss franc for some reason. Look at this. Sheesh. If you were just to buy some of this just 8 days ago, it's up 8%. That's even a bigger spike than gold, which is interesting. But this is why global macro is so important, is because you can figure out like where these bullish markets are happening so that you can asset your or allocate your assets appropriately. This was still bullish within this area here. And part of the correlation tables that we provide to our members every single day in our macro investing community, we produce correlation tables for everyone. And let me just pull up a chart of this real quick here. 1 second. So this is the most recent one, and I'll blow this up for everybody. So this is an R squared correlation versus the S&P 500 in the past 30 days. And so we know that the S&P 500 is bearish. And so things that are oppositely correlated, that are in bullish trend, that's where you want to be allocated. And look what's been more in a bullish trend that's oppositely correlated to the S&P. Japanese yen, euro, Swiss franc, as well as a little bit of 10-year bonds, as well as gold. And that's it. So it's been a very narrow market, but there are bull markets that are happening. But it is interesting how this is signaling just a large global scare right now. Let's see. Let's get into some of the data here. All right. So last week we saw that the consumer price index for the S&P 500 dropped to its lowest level, 2.8% since, let's see, I think it was April of 2021. So we continue to see inflation go down. Now, the context of which inflation is going down isn't because, okay, great, prices are coming back under control because of supply chains. This is actually demand slowing, which, remember, whenever you think about inflation, you have to think, is it because of demand coming down, or is it because of supply chains improving? Because you can either have demand side inflation or supply side inflation. COVID, well, obviously the Federal Reserve and the government printed a bunch of money, so that added to the inflation. But also, too, the crazy supply chain disruption, that was the main driver of inflation. And so, post-pandemic, as supply chains started to come back and normalize, the majority of this disinflation that we experienced from 2022 to now, most of that has just been due to the fact that supply chains have come back into balance. But the Fed, their raising and lowering of interest rates, that only affects the demand side inflation. And so even though we had supply side inflation, the Fed was using a tool that doesn't even work on it to try and fix it. It doesn't make any sense, but that they wanted to seem like they were doing something. And so really you had a tightening when really the inflation wasn't because of any type of loosening, or the majority of it wasn't. But the reason why inflation has been sticky for the past year and not going towards the Fed's 2% goal, and it's been really stuck around 3%, is because they printed so much, right? And so maybe if they didn't print as much and supply chains came back into balance, then you would have had a really fast recovery back down. But because they printed so much, you guys get the point. I'm repeating myself at this point. Going through more of the data here, core producer prices. So this is the inflation from producers. This came down 2 months in a row, but it still remains elevated, nowhere near the December 2023 lows. So so producers are still experiencing elevated prices. Now, the problem that we're seeing is that the consumer is pretty much tapped out, meaning that even if they try to raise prices, people are just cutting back on expenditures a lot more right now. And so if that's happening, then a lot of these large corporations, that's going to start eating into their margin, which is almost what the stock market is signaling right now, is that, wow, this demand destruction that's going on right now is going to directly, even though prices are going to remain elevated, they're going to directly impact margin, the margins of these companies. That, as well as the whole Trump administration, deglobalization effort, that also, puts pressure on prices. And with demand slowing, that can even further in the long term eats margin. And so it's interesting that you're seeing a lot of the forecasts for earnings just completely get, torn down so far this year. So it's a combination of like short term as well as medium term squeezing of margins there. Also, one of the main leading indicators of growth that we like to look at is heavyweight trucks sales. And so obviously, if businesses are expanding, things are doing well, you're going to see an increase in heavy truck sales because, shipments are increasing, all that. But heavy truck weight sales have declined to its lowest level since the pandemic, since July of 2020. So that's not good. So demand definitely isn't, recovering. Just giving you guys hard data from all the stuff that I'm blabbing about right now. And like I mentioned before, expectations, if they're bad enough, can actually manifest themselves into reality. And so you're seeing consumer expectations of unemployment rising to its largest point since 2008. You're seeing consumer sentiment at its lowest level since 2022. And then before that, if we go all the way back, the last time it was this bad was April of 1980. So consumer sentiment dropped off. Expectations, also incredibly low, have been dropping off. And then the 1-year inflation expectations has accelerated. Now, this is one thing that my team and I think that the consumer is incorrect about. But in terms of the fear that's happening right now, that can actually start to still manifest itself. Getting into some of the more positioning type of sentiment indicators. When looking at the put-call ratio, CBOE put-call ratio, when this blue line is accelerating, the red line is the S&P. But when this blue line is accelerating, you can think of that as increased bearishness. When this is decelerating, you can think of that as increased bullishness. And so if I zoom in here on the 1 year, you can see that as of recently, look at this huge widening that we just happened. As the S&P has dropped, bearishness, there's more puts than calls, has accelerated to levels that are near where we saw in August of last year. If we go back even further, this was around November of 2023, which was near the market bottom, or near one of the market bottoms before the S&P really took off. But as you can see, we're now at peak bearishness, or we're getting close to extreme, or we are at extreme levels of bearishness in terms of the options market. So this is another look at that 1-year inflation expectations. Hasn't been this high since 1981. We also have the ratio of insiders selling versus buying. This is one interesting metric. So the ratio of insiders So these are people working at companies that are either buying or selling their own stocks. We're starting to finally see a deceleration in this, meaning that we're finally getting net buying coming back as the market declines. Now, this doesn't mean that you want to go out and automatically buy the dip, but it's just showing that we are entering a new era here, because this is pretty much remaining in a bullish trend since June of 2023, really since it bottomed in July of 2022. So the last time this really went incredibly bearish was around summer of 2021, and then it really started to drop off around August and fall of 2021, which was near the market peak. And then, as you can see, this continued to decline as the 2022 bear market happened. And so, as the reason why I bring this up is because when this starts to decline, you want to have it on your radar. Which, if you guys want this website, it's just fintel.io/sector. But you want to see this come down and start to settle, which normally that's when you want to see, okay, along with this, are we getting the other bullish flipping indicators as well? But this is something that you guys need to keep track of as well. Insider selling versus buying. Let me see here. Okay. Getting into the GDP now estimates for the Atlanta Fed, that remains negative. Jim Bianco over at Bianco Research did a really good analogy for the Atlanta Fed's GDP nowcast, because this has obviously been in the news a lot. I'm sure you guys have heard that, GDP now is saying that, the end of the world is happening. The way that Jim Bianco characterized this is that, if you look at a runner, like a long distance runner, let's say that they go out and sprint like the first mile, and it's like, oh wow, they just ran a 6-minute mile. Well, man, if they're running a 6-minute mile, they're probably going to continue that 6 minutes throughout the entire marathon. No, that's not true. Obviously, they're going to get fatigued, get tired, and the first 1 mile split isn't going to be the same as, maybe if they're obese, but it's not going to be the same as mile 26, right? That split. And so what this is saying is that, yes, that's what we're seeing right now, but this could very much change. And so the reason why I'm bringing this up is that just because Fed now is saying like, oh my gosh, the end of the world is happening, it's just like an interval timestamp. You have to look at other things, but it is interesting when you look at the trends. But that continues to showcase, and we probably will have a negative Q1 2025 quarterly GDP growth there. Inflation nowcasting for the Atlanta or the Cleveland Fed. Let me just zoom in here for a second. That's the month-over-month data. This is the year-over-year. So remember when we were talking about how the 1-year inflation expectations for University of Michigan from the consumer has been accelerating? Well, the Cleveland Fed has CPI coming down just like we do. So it is interesting how the Cleveland Fed is also disagreeing with sentiment, and why it's on our view that inflation will continue to decelerate from here. Now, the rate of that is still questionable, but we think it's going to keep going down. In terms of financial conditions, though, they still remain relatively stable. So with all this craziness that's going on, you have to remember there's public liquidity and private liquidity. Public liquidity talking about the Fed balance sheet, Treasury general account, reverse repo facilities, all that other stuff. And then looking at private liquidity, so like bank reserves, credit, that sort of thing, that actually, even though it has been getting a little bit more loose, that actually remains relatively stable from what we saw back during the pandemic spike, as well as during the 2022 bear market. So it remains stable for right now. We'll see if this continues higher. I am banking that it will, though, only because we're seeing credit spreads widen at a very fast pace. But as of right now, it's not like it's not seeing the end of the world in terms of the private liquidity space. Bank credit as well. I mean, that still remains, even though it's not accelerating, although over the last, I would say, since the middle of March, has been having a positive rate of change. But when you take a look at what's been happening since October and November of last year, it's remained down to flat essentially. So usually when the rate of change of this is accelerating, that's where the market really does well. Equities go up, Bitcoin goes up, and that's also typically when we see inflation, getting signs of inflation accelerating as well. So yeah, that's what we saw last week in terms of inflation, and so yeah, inflation continues to come down. This week coming up here, we have core retail sales on Wednesday, and that looks like that's the biggest, as well as some other growth ones: Empire State Manufacturing, Philly Fed, which those will probably be continued signs that growth continues to slow. It will be interesting if we see a reversal of that. Like I said, if inflation starts to continuing to come down, but growth starts to show positive signs, then you'll probably have more of a larger rebound in equity markets and Bitcoin. And if that sustains, then I would be looking for a reversal where, the bookshelf might become yellow for neutral, or possibly even bullish again. So I will be looking for, what Philly Fed as well as Empire State, that's New York Fed Manufacturing, what they showcase there, as well as retail sales. All right, let's see here. So one of the reasons why the title of this video is that something broke is because we have our typical outcomes for the macro environment based off of the dollar and bond yields. Now, obviously, this isn't like what happens every single time. It's just a general guidance or a template that you use in order to gauge of like where we're headed. It's not as binary of like, this is the environment we're in, then we have to buy this. You always have to say, okay, this is typically what happens, but what is actually happening and where are we going from here? But seeing that the dollar is falling, so looking at this last row here, the dollar is falling, bond yields are rising. That's typically a sign of accelerating inflation while the dollar is weakening. And that's usually when both in the short term and the medium term, stocks, Bitcoin, risk assets rally. And so last week we did have a bounce in equities. Doesn't mean they're still bullish, but typically you're also seeing gold. I know it doesn't show it here, but typically you see gold decline as well. And now that gold is actually making all-time highs, it's interesting how this last row here isn't playing out exactly as expected. But we could morph into it if we continue to get this bounce. Now, this right here, this table, for those of you who are joining on the stream online, this is actually part of our global macro dashboard, which is included in the Ultimate Macro Investing Toolkit. And if you want access to this, it goes through a lot of our different, indicators. You can import this directly into your trading view. It's the same one that I use right here. Just DM me the word toolkit and I'll send this to you. All you got to do is, put in your email so that we know where to send it, and you'll have that there. But that quadrant is very important just to reference where we're at in the current macro environment. And so, yeah, last week was pretty rare. We'll see what type of follow through happens this week. I wouldn't be surprised if we continue to get a little bit of a bounce in the markets from here. But yeah, that's pretty much what I am seeing. And so, lastly, before we get off of streaming and getting into the questions from our members, the last thing that we'll take a look at is the target rate probabilities for the Fed meeting on May 7th, which is coming up here in the next 3 weeks. And so as of right now, there is an 80% chance that they remain paused. So even though the market might be signaling like, hey, the Fed could be cutting, right, with the dollar selling off, they're not showing that in the current target rate probabilities right now. Now, there was an interesting intra-week move where I think it was on Wednesday. This was a 50-50% chance, and then it reverted back to heavily leaning towards just remaining paused. But if we get into the freak out, there's going to be a lot of volatility that remains in the market. And because of this volatility, you really want to remain patient on just trying to buy dips in stocks, which we've already talked about. Now, from here until the June meeting, the bond market is pricing in then a 63% chance that they cut by just 25 basis points. Now we'll see what that actually entails into, but obviously the bond market is pricing in something interesting happening between now and the June 18th meeting. So in summary, we're not out of the woods just yet on, calling this bounce something that's materializing into something that could be a bottom, not calling for a bottom at all. The reason why I bring that up is because I see people trying to call bottoms in places like Twitter and on YouTube. A lot of these are the same people that were telling you that we were about to have a altcoin season right before we had one of the worst bear market or worst sell-offs in stock market history. But yeah, I would just be cautious about some of those types of creators. But yeah, if you guys appreciate this content, definitely keep up with the daily videos that we do on our social medias throughout the week. We go live every single day at 3:30 p.m. Eastern time. And if you want to join the discussion here on the Sunday Macro Wrap Up in our membership group, you can go to the link in my bio. For those who are on YouTube, just go to the description below, and you can check out our macro investing community through our school community. And there's a 7-day free trial in there, so that you can just test things out to see how you like it. So no obligation. But from here, we're going to go ahead and switch on over to members only. So we appreciate everyone for joining. Catch you guys next week, but we will see you later. Bye. For those of you that are on the Zoom call here, just one moment while I end the stream.